Kenya, a country known for its vibrant culture and stunning landscapes, is now facing an economic crisis that threatens to overshadow its natural beauty and rich heritage. The bustling streets of Nairobi and the lively markets are now tinged with uncertainty as the nation grapples with severe economic challenges. The nation is grappling with high interest rates, soaring debt, and a weakening currency, creating a perfect storm of financial instability. These challenges are casting a long shadow over Kenya's economic future, affecting businesses and households alike. The situation is a stark reminder of the complex economic realities facing many developing nations today, where progress can be swiftly undermined by financial turmoil. The crisis has raised serious concerns about Kenya's ability to sustain its growth trajectory and maintain investor confidence. For years, Kenya was hailed as an economic success story in Africa, a beacon of hope and progress on the continent. The country achieved impressive economic growth rates driven by innovation, entrepreneurship, and a dynamic workforce. But the current economic turmoil threatens to derail this progress, putting at risk the gains made over the past decades. The situation demands urgent attention and decisive action from both the government and the private sector to prevent further deterioration. The roots of the crisis are complex and multifaceted, involving a mix of internal mismanagement and external pressures that contributed to the current economic climate, from global economic slowdowns to domestic policy decisions. Understanding the factors at play is crucial to navigating a path toward recovery and ensuring a stable future for the nation. The following sections delve deeper into the key aspects of Kenya's economic crisis, analyzing their impacts and potential solutions. We aim to shed light on the path forward for Kenya. The high cost of borrowing interest rates and their impact. One of the most pressing issues facing Kenya's economy is the high cost of borrowing. This affects not just large corporations but also small businesses and individual consumers. The Central Bank of Kenya has implemented high interest rates to combat rising inflation. These measures aim to stabilize the economy by controlling the money supply and curbing excessive spending. While this aims to stabilize the economy, it has come at a cost. The high interest rates have made borrowing more expensive, which has a ripple effect on various sectors. Businesses and consumers alike are feeling the pinch of expensive loans. The increased cost of borrowing makes it difficult for businesses to invest in new projects or expand. For businesses, high interest rates make it more expensive to invest and expand. This is particularly challenging for small and medium-sized enterprises, the backbone of Kenya's economy. Many SMEs are struggling to secure the financing they need to operate and grow. Without access to affordable loans, these businesses find it hard to maintain their operations, let alone expand. The manufacturing and agriculture sectors, crucial for employment and export earnings, are particularly vulnerable to these high borrowing costs. These sectors rely heavily on loans for equipment and operational costs. Consumers are also feeling the strain of high interest rates. The cost of loans for homes, cars, and other necessities has become increasingly expensive, putting a strain on household budgets. This limits consumer spending, which further slows down economic growth. When consumers cut back on spending, businesses see a drop in sales, leading to a vicious cycle of economic slowdown. The high cost of borrowing is creating a ripple effect across the economy, impacting businesses and individuals alike. The challenge now is to find a balance that will stabilize the economy without stifling growth. Trapped in a debt spiral, Kenya's soaring debt burden is a growing concern for both its citizens and policymakers. Kenya's economic woes are compounded by its soaring debt burden. The country's debt-to-GDP ratio has reached alarming levels, exceeding 70%. This ratio indicates the proportion of the country's debt compared to its gross domestic product, and such high levels are unsustainable. This means that Kenya owes more than two-thirds of its annual economic output. Much of this debt is external, requiring significant portions of government revenue to service. The reliance on external debt makes the country vulnerable to global economic shifts and currency fluctuations. The high debt burden has severe consequences for Kenya's economic stability. It creates a ripple effect that impacts various sectors of the economy, from small businesses to large enterprises. It limits the government's ability to invest in crucial areas such as infrastructure, healthcare, and education. These sectors are essential for fostering a healthy and productive population. These investments are vital for long-term economic growth and improving living standards. Instead of allocating resources to these sectors, a significant portion of the budget is directed towards debt repayment. This stifles potential advancements and development. The government has implemented austerity measures and explored debt restructuring options to address the issue. These measures include cutting public spending and seeking more favorable loan terms. However, these efforts have yielded limited success. The austerity measures often lead to public discontent and can further slow down economic activity. The soaring debt burden continues to loom large over the Kenyan economy, hindering its growth potential. The economic slowdown affects everyday life, from reduced business opportunities to higher living costs. It is a vicious cycle where high debt leads to reduced spending, which in turn stifles economic growth, making it even harder to manage the debt. Breaking free from this cycle requires comprehensive economic reforms and sustainable financial strategies. Currency depreciation and its consequences. When a nation's currency loses value, it can ripple through the entire economy. Imported goods become more expensive, leading to higher inflation. This erodes purchasing power for everyday consumers. It's a complex issue requiring careful management and strategic planning. Policymakers scramble to stabilize the economy. They implement measures to control inflation or seek financial assistance from international bodies. But these solutions are not immediate, and the clock is ticking. It's a high-stakes game where every decision counts. When investor confidence wanes, investment slows down. Investors, both domestic and international, play a crucial role in any economy. Reduced investment can lead to slower economic growth. It's a vicious cycle. Lower investment means fewer jobs, affecting consumer spending and economic health. Navigating Kenya's economic crisis requires a multifaceted approach. The government, businesses, and citizens all have roles to play. It's about balancing short-term relief and long-term sustainability. Strategies include diversifying the economy, improving infrastructure, and fostering innovation. It's a challenging journey, but with the right moves, recovery is possible. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.